welcome back to Financial Focus Radio. Thank you for joining us on this chilly weekend here in the Pacific Northwest. Pac-12 football starts this weekend, so Josh is quite excited. My name's Tyler Simones. That guy is Josh Fenili. We are partners at Northwest Quadrant Wealth Management here in Bend. Isn't it weird how, guy from New Hampshire and a guy from Bend, Oregon are now business partners? How the heck did that happen? Good old Athletic Club of Bend.
Athletic Club of Bend, indeed.
All right. For all of you people that are in the Medicare stage of life, so if you're over 65, it is that time of year. Open enrollment season has started. It started actually in October, and it goes through December 7th. So I would urge all of you, if you haven't looked at your Medicare supplements, any part of your Medicare, you should be doing that because there's a good chance you can either increase your benefits or reduce your costs. So our health insurance expert, Don Klipnis, with health insurance strategies here in Bend, he tells people they should look at least every 2 or 3 years at their health insurance benefits. And so it's that time of year. The other thing is, if you need to look at your group plan, maybe you can save some money there. We look at our options every single year. We just don't automatically re-up it. And so it's something we think everybody should be doing. Before we talk about our shame of the week, I do want to bring this up because we know with everybody being home all the time because of COVID, we know all of you, no matter what stage of life you're in, are looking at your investment accounts way more often than you normally do. And we actually, in our office, we have a dashboard that on our trading platform where we can actually see
how often people check
how often
their
our clients are looking, which clients, when during the day, all this stuff. It's amazing. People look at like 3 in the morning, like somehow the market's changing at 3 in the morning.
There's an irrational number of people that are checking multiple times after the actual close.
Yeah. So here's. I mean, I'll tell you this. I sit in front of my computer all day long. Josh and I both do trading for clients, and doing all the stuff that is our job. And I didn't look at my account last week. I mean, I know intuitively what my account's doing because I guess I made some trades in my account, but I didn't actually look at the holdings. I just added a new holding, and so I didn't actually look at my account, like the number and all that stuff. And so, looking at your account often does not serve you in any way. And quite frankly, I want to know what the thought process is by looking every day. What are you trying to solve? Is it something to do with your ego? Is it make you feel better? Like when you're looking once a day or multiple times a day, what is it that you're trying to figure out? What are you trying to know that you didn't know before you looked at your investment account on a daily basis?
Well, one of our clients actually asked me this week about our custodian's app to check theirs. I don't even have it because I don't look at my account every day. I mean, I intuitively know just by being at the office, but we have a data aggregator called eMoney that it has a live Zillow feed in there, and people are able to check their net worth every day based on the value of their house and the combined value of their investment accounts, and it's admittedly addicting, and so many people are at home and in front of the computer, and so there's just this, this level of boredom has sort of maybe fed into it a bit.
But my question, and I don't know the answer to it, and it's sort of a question that I'd love to get some feedback on from our audience, is what are you trying to figure out? Like, what is it when you look at in eMoney's case, your net worth?
Does it change your behavior? Is when we grappled with it this week, is we wondered if people's behavior was going to change, if it was going to influence their spending patterns.
Yeah. So if you have $1 million IRA, let's say, and let's say your account is either up or down 2%, which is $20,000. What do you do differently or not do because of that up or down $20,000, and how does it make you feel? Yeah. I would submit that it is not good for you because it creates anxiety on both sides of the fence. And if it's changing your behavior, you're not helping yourself. So, as Buffett said, the best thing for most people would be if we opened the market once a year, decided what these businesses were worth, and then closed the market again. But that's obviously not the world we live in. And so you all are looking often. And it's not just our clients, it's people just generally are doing this all the time. And my question is, and I'm going to start asking clients, especially the ones that do it a lot, what is it when you go to look, what are you hoping to see? And then what happens afterwards?
Well, they're hoping to see it go up.
Yeah, they want to see green, right? Up and to the right. But I don't I don't necessarily know if they're getting what they want from looking at it. And then when it's down, then it's just a really interesting thing.
The likelihood of making a bad decision is directly correlated with the frequency of checking.
Oh, 100%.
Yeah.
100%. All right, let's kick off our shame of the week. And this week, I sort of wanted to talk a little bit more like we did about what we did last week and talk about the truth, sort of shocking truth in professional financial advice and what is happening out there in the financial advice world. Our industry doesn't have the best reputation, and I'm not here to defend it. I think rightfully so, the financial advice business has a bad reputation because financial advisors, a lot of them are very bad at telling the truth and or bending the truth, and they're very bad at being transparent. And so, and you, the retail investor, sort of know that, and you feel that you're not getting the whole story. And so that's why there's this sort of a confrontational relationship between the retail investing public and financial advisors. And the thing that amazes me is in this business, you can do the right thing by clients. Our motto at our business is if our clients knew everything there was to know about investing, we want to do what they would do if they knew everything there is about investing. And as much we invest our money alongside our clients, and we think everybody should do that. And we charge our clients a fee, and they see the dollar amount on a quarterly basis, and we're very transparent about it. But the biggest thing is sort of knowing some of these ways, making sure, most importantly, you understand the way that you're paying for financial advice. TD Ameritrade did a study. Over 70% of people thought they weren't paying their financial advisor. How does that financial advisor make a living? Of course you're paying them. So there's a commission-based advisor, there's a fee-only advisor, and there's fee-based advisors. And you have to have a thorough understanding of exactly how you're paying your financial advisor to know how they're going to behave in the relationship. I'm not here to tell you shouldn't have a commission-based relationship. I don't think you need one, because if that's the relationship you have, you can go do it on a trading platform much cheaper. But understand what that is and know all the fees you're paying. So, in our case, we use exchange traded funds that track indexes. There are fees associated with these ETFs. They are very low, but we are, they do exist.
Just as an example, when we bought the business in Eugene, many of the accounts that, the brokerage retirement accounts that we took over were in what's called C shares, and they don't actually disclose the fee that you're paying, and they were significantly higher than the weighted average cost of the exchange traded funds we use plus our 1% overlay fee. But the fee was now transparent, and originally there was a lot of confusion because many of our new clients thought their fees had actually gone up, though they'd been reduced by an order of 50%. But it was very, very stark awareness for them.
So people think that professional portfolio advice costs money, but they think it's worth it. Advisors will say it costs, but returns are higher than doing it alone. You'll get returns that consistently beat the markets. Look at the returns I've gotten for these clients. And so the reality is, most actively managed funds, when I say most, almost all, don't beat the index. So that's why we use the index. So just you want transparency and you want the truth in financial advice. And the shame is so many financial advisors don't tell the truth and aren't transparent about what they're doing. All right, if you want to be part of the show, give us a call, 877-670-7117, or go to our website, financialfocusradio.com, and send us an email. When we come back, we're going to talk our Financial Focus University about preferred stocks, so stick around.
Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Northwest Quadrant Wealth Management, a registered investment advisor and separate entity from LPL Financial.